All right, so here's the deal partner program. You invest in a property that we own. We're going to renovate the property, and then we'll either flip or rent the property. You get to share in the equity and profits. So, super simple structure. The reason we're able to do this is because we just have access to a lot of deals. We've been purchasing packages of properties, larger properties, and long term tenants. As they move out, we could either just re rent the property or we could do what we're doing, which is maximize value, renovate it, get the rents up, get the value up, and do it that way. And so that's where you would come in as a deal partner is you would provide the holding costs and rehab funds to maximize the value on these properties, and then you get to be a passive partner and share in the equity in the cash flow and in the profits on the sale. So with that, we have two main exit strategies. We've got just a short-term flip. We go in, renovate the property, and put it on the market to sell it. And the other strategy is a medium-term rental. And this is for properties that perform best as rentals. We would get in there, renovate it, get it leased out as quickly as possible, which our leasing team is killers. They're down to two available units for our whole portfolio of hundreds of units. So they're doing a great job. Um, anyways, we would lease it and target about a 1 to 2 year exit. It's just kind of the sweet spot of 2 years to maximize the returns for you from cash flow, and then you get the appreciation, the debt pay down on the property. That's all the stuff that people love about real estate. So you get to participate in that for the 2 years, and then at some point around there, we would sell it and all run to the bank and be super happy. So the deal structure, how we would do this is up front, you would pay for two things. The first one is a holding cost for 6 months. So that 6 months, if we're flipping it, should give us enough time to renovate it, list it on the market, and sell it. Or if we are holding it as a rental, that'll give us enough time to renovate it, get it rented out, and we'll get it done hopefully way before that 6 months is up, get it cash flowing, and that'll just boost our cash flow, boost your returns. So you'll pay for the debt service and the renovations. We'll divide up the equity on the properties just based on a deal by deal basis, based on the property, based on the ROI that we're expecting. And then if it is a rental, the cash flow will be paid out to you quarterly based on whatever percent of ownership. So let's say there's $1,000 of cash flow for the quarter after all expenses are paid, and we're 50-50 partners on it. You'll get half of that, $500 of cash flow for the quarter will be paid out to you. And then if and when the property sells, if it's a flip or if it's a medium term rental, whenever that property sells, first thing that happens, every dollar you invested gets paid back to you first. Then whatever actual profits are left over on the deal gets split based on equity. So let's say we sold a property, made $50,000. You had invested $10,000 into the property. The first $10,000 goes to you, and then the next $40,000 gets split if we're 50-50. So you would get another $20,000. We would get another $20,000. So that's how the deal structure would work. So it's pretty simple. And I do have some FAQs I'll go through here real quick of just things that you might be wondering that other people are probably wondering too. So the difference between a deal partnership and a private money loan is that private money loan is just debt. You just get a set interest rate and that's it. This one, you're getting equity. So because you're participating in the deal, there's no guarantees, right? It's just like you're the investor, you got your own deal. But because you're participating in it, you get to share in that upside potential. Whereas on a private loan, you don't get to do that. The next obvious question is, what's in it for us? Meaning me, Austin, Thunder Sun Homes. Why would we do it if we've already got this big company and we've done all this stuff in real estate? Well, for us, it is going to help us scale our operations. Just being able to bring in deal partners is going to allow us to take down more deals because right now we don't have a shortage of deals. We have been pumping the brakes because we want to make sure we can execute on all these deals properly. We have a surplus of deals and opportunities, and most people don't have access to that. And so for us, bringing in you and other people as a deal partner, it's going to allow us to just take down more deals, and we're sharing the equity, yes, but we're able to scale our operations a lot faster. That's really what we want to do, because there's a lot of opportunity out there right now. So that's why we want to do this. Why would you partner with us? Like I talked about, you get access to the deal flow that we have that no one else has. And we see a ton of deals, and we have a bunch on the board right now that you could potentially partner with us on. We've got our proven expertise. We've got a long track record, over 9 years now doing this. Crazy. You might want to do this if you want to get paid on equity as opposed to paid on your labor or just paid on your time. And then generating passive returns. So everyone and their moms knows, you want to be invested in real estate. It's a tangible asset. It's physical. The list goes on and on and on. We all know it. But you get to do that passively. So you don't have to go find the deals. You don't have to go do all the construction work, all that stuff. And you can just be a passive deal partner. And the last kind of logical question we like to think of, okay, what if at some point you're invested and you're like, I want out of the deal. Let's say it's a rental deal and it's going great on cash flow, but you're like, I'm ready to get out. If one of our deal partners wants to get out early, we have a predetermined structure for that, where we'll let you exit at 20% above whatever you've invested. So if you've invested $100,000 into a bigger deal, you can call us at any time, say, hey, I want to get bought out of the deal. And you would get bought out for, in that case, $120,000. So 20% above whatever you invested. That would be an owner finance note at 6% interest paid to you on the 20% premium. So that's a pretty bold setup to have, because in theory, people could come in, invest the money in the deal, and then the